What is going on, everybody? Welcome into today's video. I'm going to be teaching you guys how to determine some daily bias today. It's going to be a banger video. So a lot of people have been asking, how do I determine my daily bias? Whether that's me trading on my levels strategy, which is a fairly new kind of strategy, or my AEM strategy, which is my only other strategy. And this applies for both of them. You're going to obviously get the best trades when you're following within your bias. So I'm going to be giving you guys a full breakdown. I did not take any trades today, but I will go over the trades that you could have taken, which is not very many, but we're still going to go over it. But yeah, it's going to be a full breakdown, full, boot camp, I guess you could say, on how to determine daily bias. So without further ado, let's go ahead and get into it. So, alrighty. We have our chart right here. First thing you're going to do, you have to start off on the daily time frame. Come on, guys, it's daily bias, all right? So start with our daily time frame, and then we're going to be marking out the previous day's high and low. So it's going to look something like this, okay? Previous day high and previous day low, okay? It's very important that you mark these out, as these are very good pools of liquidity that usually, give reactions, okay? So previous day high and previous day low. Now we're going to start looking for fair value gaps and liquidity. Okay, specifically fair value gaps that have not been traded into. Okay, and as you can see right here, all right, well, we have a gap here, but the market's already traded into it, so we're not going to use that one. Now when we come down here, we see a gap that has not been traded into and is unmitigated. We want to mark this out. It is very unlikely that today we will dump all the way down to this level. But still, you want to be marking these out for your charts. Now, you're going to see more of these on the 4 hour, the 1 hour, and those other time frames, but we're going to get into that. Here, you can also see what is called a volume imbalance. Okay, a volume imbalance is essentially when you see a fair value gap that's inverted but not inversed. And I just made that way too confusing. It's this right here. It's when you see a gap between the candles. So with a fair value gap, you're seeing a gap between the wicks. This, you're seeing a gap between the candles. So these volume imbalances are very important, but they're not the most important, as I want to show you something that's very similar. Okay, this similar thing is called a new week opening gap. Okay, you'll see this a lot of the time abbreviated as, oh my gosh, that's awful, INWOG. Jeez, that's the worst drawing ever. Okay, or INDOG. Okay, so you want to be very familiar with these terms. This is essentially whenever there is a gap, whenever the market opens. So it closes on Friday and gaps up or gaps down on Sunday at market open around 6 p.m. Eastern Standard. So right here, we're going to scale down to the 4 hour time frame, and I'm going to show you that new week opening gap right here. So notice how there's a literal blank space. This isn't a fair value gap exactly, but it's a literal blank space in the chart. Okay. Now, I'm not sure if everybody does it this way, but I've seen the most success marking them out a little differently than I think most people do. Instead of marking it from wick to wick like a normal fair value gap would, you want to be marking this out from the candle close, so right here, and then you want to be moving it up to the candle open up here, kind of like that. And you can see the market is literally currently, as I'm recording this, treating this like a fair value gap. I told all of these students to look out for, I believe, 448, 447, 448 for a reversal today. And if you look at the, chart, bang, 448, immediate reversal, okay? So back to the 4 hour, you're going to essentially be using these as fair value gaps, but on a higher time frame scale, as in these are more likely to play out like a normal fair value gap and not get inversed, okay? These still can get inversed, but don't count on it as much as a normal fair value gap, okay? So you're ideally looking for this gap to get traded into and to go long for this example. So now we've marked that out. Once these gaps have been traded into, so we have filled it right here, we're going to delete it as we do not need it anymore. Okay. Now we're going to be looking for unmitigated gaps and liquidity here on the 4 hour. So right here we can see all-time highs. We left behind this swing high, so we can just mark this out and say all-time highs here. Another one we can do is we can continue looking further below and below, and we can see that we have this sell side liquidity right here. We're going to be marking this out as, I will just say, 4 hour sell side liquidity. Okay, unlikely that we'll trade this far down. It is possible, but unlikely that we'll trade this far down in the span of a day. So these are my levels I have marked out so far. Now we're going to scale down to the hourly time frame. Okay, you're gonna start noticing the lower you go, the more fair value gaps and the more swing points you're gonna see. So we had previous day low here, but we also left behind this right here. So what I'm essentially looking for here is, all right, we have this, swing low that's right under previous day low. I want to see which one the market wants to create an inverse around. So a lot of people get confused which pool of liquidity is the one I need to take a trade off of. Okay, you're gonna know whenever you see price dip below and then form an inverse to the upside and go like that. That'll usually confirm that that's the low that's going to get traded into. Or you're going to see something like a change in the state of delivery where the market closes and goes like that. Okay, very similar, but that is how you kind of confirm that that low is the right one. There's also an issue with a lot of people who want to use turtle soup strategies where they're basically just trying to scalp off of these key liquidity areas, because the market could just push through. Say you wanted to long immediately after the market hits this previous day low, the market could just pump lower, and you can get a more precise entry by marking out these swing points. So for this, I would just be saying 1 hour sell side. So it would look just like that. Now, everything else, we're looking pretty solid. Let's go back up here, see if we can have these fair value gaps. Okay, it's very close, but this gap has already been traded into and the market is rejecting it. Okay, so right now we're kind of just sitting in this kind of medium area where we are respecting bullish but also respecting bearish. Now we're kind of waiting for further confirmation. We want to ideally look for the market to form more price signatures to get a better read on the market. So now I'm going to skip other time frames and go to 15. Okay, 15 gives you very solid directional bias. So right here, this is a very bad price action day. Today is Monday. We have no news. We have news the rest of the week. Today was just really iffy. We just had tariff news. I believe it was a 0% tariff on Europe. Not completely sure. I'm like pretty sure, but not completely sure. So that's why we gapped up. But this is basically what you're going to be looking at. Now notice we have this 15-minute time frame swing high right here. So 15-minute swing high. So I'm keeping all of these levels, in mind. Another thing we can mark out is this swing low. And the thing is, I say this a ton, you want to be finding these levels that are like extremely prominent. So the ones that like stick out a ton, like you could literally like, I could go all the way back here. By the way, yeah, I changed my setup around and moved my desk. But if we go all the way back here, I can still see that freaking swing low. I can see the 15-minute swing high, and I can see all-time highs. And I have bad eyes. So yes, I can see these. That is what makes it prominent. If you can literally stand at the other side of your room and see the freaking level, it's a good level, okay? So just keep that in mind. So we're looking here. Another thing we can mark out is these two relative equal lows, okay? Now, you're not trying to get analysis paralysis and adding 15 bajillion freaking levels to your chart, but you just want to have a good idea of where the market might want to go, because you have to think of this as a very fractal mindset. The market is fractal. So when we look at this 15-minute swing high, you might be like, okay, there's so many levels on my chart. I'm extremely overwhelmed. I'm confused. Well, it's very unlikely that we're going to dump actually it could, but it's fairly unlikely on a low volume day like today, we're going to dump all the way to the 1 hour sell side liquidity level. Okay, and you might be thinking now, well, how does this tell us if we're bullish or bearish? Okay, so right now I've kind of just shown you everything you want to mark out, but here's how I kind of determine this. Okay, if we start wicking very hard, so say that we basically fill this new week opening gap and immediately form an inverse to the upside, I would then turn bullish. Okay, too many people are trying to predict the day, but not have an actual bias. A bias does not mean to predict, oh, is there going to be bullish or bearish? That's not the right mindset. You don't want to also be forcing your bias. So what you want to look for is, okay, under conditions, I am bullish under this condition, I'm bearish under this other condition. Meaning, you're not trying to predict, I don't know right now, I personally do not know, is the market going to go up or down right now? Okay, that doesn't mean I'm a bad analyst, but this basically means I'm very reactive, I'm reactant. I'm not sure if that's a word, I think so. That's a crazy, oh my god, it's going to get clipped. But yeah, you want to be very reactive to the market. So we have a 15-minute swing high. Say that we go up here and then form an inverse fair value gap to the downside. I'd obviously be bearish, but I'm not trying to guess if we're going to go to that swing high. I'm just waiting for one of these levels to get hit and then form a reaction. You're not trying to guess. You're literally, too many people think you're trying to guess, oh, is it going to go up or down? No, obviously, I mean, the point of trading is to be right and to go up or down, but you're not trying to guess it. You're trying to be, you have to set parameters and conditions. So if this happens, then I'll do this. If this happens, then I'll do that. Okay, you have to think of it that way. So let's scale down. The 5 minute, this is really I'd honestly say this is my favorite time frame. And the reason why is because it gives you that directional bias, but it's lower time frame enough to where you can take entries on the 5 minute. And I don't take entries on anything over the 5 minute. I stick to the 30 second to the 5 minute. I don't exceed 5 minutes. Also, if you guys keep seeing me looking over here, I have like my webcam over here, or my webcam's here, but I'm looking over here just to, I don't know. Anyways, yeah, so you're going to be having your swing points, all of these right here, and you're waiting for the market to react off of these levels, okay? So you're not trying to guess anything, and with the 5 minute, it keeps things very simple. We can see here that this price action is low-key trash. We're literally chopping. We're chopping very hard. I mean, yes, we had a liquidity sweep right here, and then a small pull to the upside. But the thing is, we're not getting extremely solid PA. In fact, I like PA where it's like this, where it's very rangy, and you can, catch moves, okay? Right here, you're not really catching much, okay? It's pretty trash, in my opinion. I know it's pretty funny. A lot of the students who trade the new level strategy in the Capital Academy, they managed to bank off of this today, but I was pretty focused just on being very patient today, preserving capital. So most people either didn't trade, or the people who traded levels caught a couple, scalps and made some money. So that's the thing. This is a very good framework for forming a daily bias, because I called today, and on the call this morning I said, okay, I am bullish. Now, after the call, what does the market do? All right, so the call is at 9:15. So when we go here, we can see, all right, market's right here, it goes bullish, and then it dumps. Now, some people could be like, okay, well, you're completely wrong. No, quit thinking of bias as a prediction. Think of bias as a condition. Damn, that was a bar. Think of bias as a condition, not a prediction. Okay, so think of it that way. I mean, you're not trying to predict it. I was looking for this to happen. I called it damn near to the point within 10 points, I called this low. Okay, I was looking for this level, and I was looking for longs off of this level. I wasn't at the charts when it got hit, so I wasn't able to take a trade, but this still played out. This was a correct draw on liquidity. So that's what you guys want to be looking for. You want to be looking for these levels, and you want to look for reactions. Once you get the reactions, that forms what your, overall perspective on the day is. Okay, so like I said, look at this as conditions. Set conditions. If this happens, then do this. Okay, that's the most important thing you can take away from this video. You're not trying to predict what's going to happen next. Okay, so for the last thing that I want you to do to basically get a good daily bias is to load up this free indicator. It's called ICT Kill Zones and Pivots. You're going to go here. It's going to mark out all of these sessions, okay? I personally usually delete this New York AM session and all of this kind of stuff. I just want to look at where London and Asia are at, okay? So you can see here, this happens a ton. You usually see reactions on the highs and lows of these sessions. So right here, London swept out Asia's high, inverse to the downside, and just dumped, okay? So you're essentially looking for these sessions to be used as liquidity areas. So you're going to use it just like everything here, like all the swing highs and swing lows, all of that kind of stuff. But obviously you want to be looking at these as your reactive areas and just using the highs and lows. So right here we have London high, you're going to be marking that out. London low, if London low has already been traded into, like this, there's no need to continue dragging it out to the right, okay? When we look here, Asia low was swept, there's no reason to continue dragging it out to the right, okay? So that is a complete framework on how to determine a daily bias and how to basically assess going into the charts in the morning and how to get a full, just a blueprint on what you need to look for. So if you guys do have any questions whatsoever, join the free Discord in the bio or the description and ask me whatever questions you guys have. And yeah, that basically wraps up today. Hope you guys have a banger rest of the day. I love y'all and see you guys in the next video. Peace.